Imagine controlling more money than the GDP of most countries. Picture your signature on a single document, moving billions across continents in seconds. Now imagine losing it all in 72 hours. September 15th, 2008. Lehman Brothers. Holdings Inc., the fourth largest investment bank in America, files for bankruptcy. $600 billion in debt. 25,000 employees lose their jobs overnight. Global markets crater by $3 trillion in a single week. But what nobody knows is this wasn't just another corporate failure. This was the spectacular end of a 158-year dynasty that began with 3 Jewish immigrants selling fabric from a pushcart in antebellum Alabama. The Lehman Brothers didn't just build a bank. They built an empire that survived the Civil War, 2 world wars, the Great Depression, and dozens of market crashes. They accumulated wealth that made them richer than Vanderbilt, more powerful than Morgan, and more influential than Rockefeller. Henry Lehman, Emanuel Lehman, Maya Lehman. 3 names you've probably never heard, controlling an institution that shaped American capitalism for over a century. At their peak in 2007, Lehman Brothers managed $700 billion in assets. Their leverage ratio hit 44-1, meaning they borrowed $44 for every dollar they owned. They weren't just playing with house money, they were playing with 17 houses worth of money they didn't have. The secret behind their rise: they understood something about American finance that nobody else did in 1844. Debt could be turned into gold, risk could be packaged and sold, and with enough leverage, you could move mountains. They pioneered investment banking. They created the first mortgage-backed securities. They turned speculation into science. The secret behind their fall? The exact same thing. This is the story of how 3 brothers from Bavaria conquered Wall Street, redefined global finance, and ultimately triggered the worst economic crisis since 1929. It's a story about genius and greed, innovation and hubris, and the thin line between calculated risk and reckless gambling. Because when you're leveraged 44-1, you're not just too big to fail, you're too big to survive. September 15th, 2008, 1:45 a.m. Richard Full Jr., CEO of Lehman Brothers, stands in his corner office on the 31st floor of 745 7th Avenue, Manhattan. Through floor-to-ceiling windows, he watches the city that his company helped build for over 15 decades. In 6 hours, Lehman Brothers will file the largest bankruptcy in American history. Full, known on Wall Street as the Gorilla for his aggressive tactics, has just finished a conference call with Treasury Secretary Hank Paulson. No government bailout is coming. No white knight buyer will emerge. The 158-year-old institution that survived the Civil War, built the railroads, financed 2 world wars, and helped create modern America is about to die. But this isn't where our story begins. What most people don't know is that the Lehman Brothers collapse wasn't the story of a modern investment bank that got too greedy. It was the final chapter of an American dynasty that began in 1844, when 3 Jewish brothers stepped off a ship from Bavaria with nothing but determination and a profound understanding of how money really works. Henry Lehman was 23 years old when he left Rimpar, a small farming village outside Würzburg, Germany. Bavaria in the 1840s was brutal for Jewish families. Restrictive laws limited where they could live, what jobs they could hold, and how they could earn money. Henry had watched his father scrape together a living as a cattle trader, never able to own land or join merchant guilds. The promise of America wasn't just opportunity, it was survival. He landed in New York Harbor in September 1844 with $900 sewn into his coat lining, roughly $35,000 in today's money. Instead of staying in the crowded tenements of Manhattan like most immigrants, Henry made a decision that would define his family's destiny. He bought a train ticket south to Alabama. Montgomery in 1844 was experiencing a cotton boom that would reshape American economics. Plantation owners were expanding rapidly, and they needed capital, not just to buy land and slaves, but to bridge the gap between planting season and harvest. Cotton was America's first global commodity, and Alabama was sitting on billions of dollars worth of white gold. Henry opened H. Lehman, a small dry goods store on Commerce Street. But behind the bolts of fabric and household supplies was a much more sophisticated operation. Henry wasn't just selling merchandise. He was learning how American capitalism actually functioned. He watched plantation owners leverage their land for credit. He saw how cotton was traded months before harvest. He understood that in America, future promises could be as valuable as cash in hand. Within 2 years, his brothers Emanuel and Mayer joined him. Emanuel, the middle brother, had a genius for numbers and relationships. Mayer, the youngest, possessed an almost supernatural ability to assess risk. Together, they transformed a simple store into something unprecedented, a financial hub that connected Alabama cotton with global markets. Behind the Lehman Brothers' success was a revolutionary insight about credit and commodity trading that wouldn't be fully understood by economists for another century. They realized that cotton wasn't just a crop, it was a financial instrument. By 1850, they were accepting cotton as payment for goods, storing it in warehouses, and selling it to textile mills up north and in Europe. They were essentially creating the first commodity futures market in America. This wasn't just about being smart businessmen. The Lehman Brothers understood something fundamental about capitalism that would eventually make them the most powerful financiers in American history. Money doesn't create wealth, leverage does. They weren't just trading cotton, they were trading promises, futures, and calculated risks. The Civil War should have destroyed them. Alabama seceded from the Union in 1861. Confederate currency became worthless overnight, and the cotton economy collapsed. Instead, the Lehman Brothers made a decision that revealed their true genius. They picked up everything and moved to New York City. By 1868, they had established Lehman Brothers at 119 Liberty Street in Manhattan, just blocks from what would become the financial capital of the world. They brought with them 15 years of experience in commodity trading, an intimate understanding of American agriculture, and something even more valuable, a network of relationships that stretched from southern plantations to European banks. What happened next would reshape Wall Street forever. The Lehman Brothers didn't just become another investment bank, they pioneered investment banking. They were among the first to underwrite railroad bonds, finance department store expansions, and create what we now call leveraged buyouts. They turned speculation into science and risk into reward. By 1906, Lehman Brothers had become one of the most prestigious firms on Wall Street. They had financed Sears Roebuck, helped create F.W. Woolworth, and played crucial roles in funding America's industrial expansion. The 3 Jewish immigrants who started with a fabric store in Alabama now controlled hundreds of millions of dollars and advised presidents. Let me take you back to that small shop in Montgomery, Alabama, in 1844, because to understand how Lehman Brothers ultimately destroyed itself in 2008, you need to understand the ambition, intelligence, and fatal flaw that was built into their DNA from the very beginning. The Lehman Brothers believed that with enough leverage, you could move mountains. For 164 years they were right, until the day they weren't. Chapter 1. Humble Beginnings. Henry Lehman could smell opportunity in the Montgomery heat. September 1844. Commerce Street buzzed with plantation owners, cotton traders, and merchants hawking everything from farm equipment to imported silks. Henry walked the dusty street for 3 days, studying every storefront, counting customers, watching money change hands. At 23, he had already developed the analytical mind that would define the Lehman legacy. Never make a decision without understanding every variable. The building he chose sat at the corner of Commerce and Court Street, a narrow 2-story structure with wide windows, perfect for displaying goods. The rent was $15 per month, nearly half his available capital. Most immigrants would have found cheaper space. Henry understood something his competitors didn't. Location determines access, and access determines profit. H. Lehman opened on October 1, 1844, with inventory worth $800. Bolts of cotton fabric, ribbons, sewing supplies, basic household goods. But Henry's real product wasn't merchandise, it was relationships. Within weeks, he had memorized the names of every plantation owner within 50 miles, their crop yields, their buying patterns, and most importantly, their credit needs. You see, cotton wasn't just a crop in 1840s Alabama. It was a complex financial ecosystem that controlled global markets. Raw cotton represented 60% of American exports, generating more foreign currency than all other American products combined. New York banks, London financiers, and European textile mills all depended on Alabama's white gold. Here's what made Henry different. While other merchants simply sold goods for cash, he studied the deeper mechanics of cotton economics. Plantation owners needed credit during planting season, but couldn't pay until harvest. Cotton prices fluctuated based on weather, global demand, and speculation. There was a 6-month gap between investment and return that created enormous opportunities for anyone smart enough to bridge it. Henry's breakthrough came during his second winter in Montgomery. James Thornton, who owned a 2,000-acre plantation 15 miles south of town, needed fabric for slave clothing, but wouldn't have cash until his cotton sold. Traditional merchants would have demanded payment up front. Henry offered something revolutionary. He would accept cotton as payment at harvest time, assuming the price risk himself. The deal seemed simple. Thornton needed $200 worth of fabric. Henry would provide it immediately in exchange for 4 bales of cotton delivered after harvest. At current prices, 4 bales were worth $240, giving Henry a 20% profit. But Henry was actually executing a complex financial transaction that wouldn't be fully understood by economists for decades. He was creating a commodity future while providing short-term financing. When Emanuel Lehman arrived in Montgomery in 1847, he found his older brother operating something far more sophisticated than a dry goods store. Henry had developed relationships with 37 plantation owners and was regularly accepting cotton payments worth more than his entire store's cash inventory. Emanuel, who had studied bookkeeping in Bavaria, immediately recognized the genius of Henry's system and its enormous risks. Emanuel was the strategic mind of the partnership. Where Henry was intuitive and relationship-focused, Emanuel was analytical and systematic. He created the first formal record-keeping system for their cotton trades, tracking not just individual transactions, but market patterns, seasonal variations, and credit risks. By 1848, the brothers were essentially operating as agricultural commodities traders while maintaining the facade of a simple retail store. The arrival of Mayer Lehman in 1850 completed the formula that would eventually conquer Wall Street. Mayer was only 20 years old, but he possessed an almost supernatural ability to assess risk and market timing. While Henry built relationships and Emanuel managed systems, Mayer focused on the core question that would define their success for the next 158 years. How much leverage could they safely employ? Mayer's innovation was the cotton warehouse. Instead of simply accepting cotton payments and immediately reselling them, the brothers began storing cotton during low price periods and selling during peaks. This required substantial capital. They had to rent warehouse space, hire workers, and pay insurance costs while waiting months for optimal selling opportunities. But it also multiplied their profits. By 1851, Lehman Brothers was storing over 400 bales of cotton at any given time, representing inventory worth more than $20,000. This was leverage at its most basic level, using borrowed money and extended credit terms to control assets worth far more than their actual cash position. They were borrowing against future cotton prices to finance current operations, a strategy that would eventually evolve into the complex derivatives trading that defined modern investment banking. Look, this wasn't just smart business. This was the birth of American financial speculation. The Lehman Brothers had discovered that in a commodity-based economy, information and timing could be more valuable than capital. They knew which plantations had the best soil, which owners were the most reliable, and how global events affected local prices. They were creating wealth not by producing anything, but by understanding money flows better than anyone else. The brothers' reputation grew throughout the 1850s. Plantation owners began consulting them not just for goods, but for market advice. Should they plant more cotton or diversify into tobacco? When should they sell their crop? How much could they safely borrow against expected yields? The Lehman Brothers weren't just merchants anymore. They were financial advisors to Alabama's agricultural elite. But this success contained the seeds of both their future dominance and eventual destruction. The Lehman Brothers had learned to see debt not as a burden, but as a tool. They understood that leverage could amplify profits exponentially. Most importantly, they had developed an absolute confidence in their ability to assess and manage risk. This confidence would carry them through the Civil War, drive their conquest of Wall Street, and ultimately lead to the largest bankruptcy in American history. Because when you've spent your entire career being right about leverage, it becomes impossible to imagine being catastrophically wrong. By 1860, Henry Emanuel and Mayor Lehman controlled the largest cotton trading operation in Alabama. They had built a sophisticated network of warehouses, developed relationships with buyers from New York to Liverpool, and accumulated enough capital to weather market downturns that destroyed their competitors. They were ready for the next phase of American economic development. They just had no idea that within a year, their entire world would be destroyed by war. But here's the thing about the Lehman Brothers. Destruction was just another opportunity to prove that with enough intelligence, adaptability, and leverage, any crisis could be turned into profit. Chapter 2. Cotton Kings. By 1855, the Lehman Brothers controlled cotton like Rockefeller would later control oil. Their warehouse on Commerce Street held over 800 bales on any given day, nearly $40,000 worth of raw cotton, more inventory than most Alabama banks held in actual cash. But the real power wasn't in the cotton they stored, it was in the information network they had built around it. Emanuel had developed something unprecedented in American agriculture, a real-time intelligence system that tracked cotton prices from Montgomery to Manchester, England. Every Tuesday and Friday he received telegrams from buyers in New York, Mobile, and New Orleans. He maintained correspondence with textile manufacturers in Massachusetts and shipping companies that moved cotton across the Atlantic. The Lehman Brothers knew cotton prices in Liverpool before most Alabama plantation owners knew prices in Montgomery. This information asymmetry was worth more than gold. Mayer had figured out how to weaponize it. While competitors bought cotton after harvest and sold it immediately, Mayer mapped seasonal price patterns going back 7 years. Cotton typically hit its lowest prices in October during peak harvest season, then rose 15–20% by February when supplies tightened. But within this pattern were microcycles based on weather reports, shipping delays, and demand fluctuations from textile mills. Here's what made the Lehman strategy so powerful. They weren't just buying and selling cotton, they were buying and selling time itself. When plantation owners needed cash in October, the brothers would purchase their entire crop at harvest prices, then store it through winter and spring. This required enormous capital and carried significant risks, but the profits were spectacular. Consider their 1857 season. The brothers purchased 1,200 bales in October at an average price of $11 per bale, a total investment of $13,200. They stored this cotton through winter, paying warehouse costs of approximately $800. By March, cotton prices had risen to $14.50 per bale due to delayed shipments from other regions. They sold their inventory for $17,400, generating a profit of $3,400 in 5 months, a 26% return on invested capital. But Mayer wasn't satisfied with 26% returns. He had discovered something that would eventually become a cornerstone of Wall Street speculation. Volatility creates opportunity. During periods of high price uncertainty, profit margins expanded dramatically. The key was having enough capital to survive temporary losses while waiting for favorable price movements. This insight led to their most audacious strategy yet. In 1858, the brothers began offering guaranteed price contracts to plantation owners. A farmer could lock in cotton prices months before harvest, eliminating his market risk in exchange for a modest discount. For example, if current cotton was trading at $12 per bale, the Lehman Brothers would guarantee a harvest price of $11,050, assuming all market risk themselves. This was revolutionary. The Lehman Brothers were essentially creating the first commodity futures market in America, 60 years before futures exchanges became common. They were taking pure speculation and turning it into a structured financial product that served both buyers and sellers. Emanuel's records from this period reveal the breathtaking scope of their operation. By 1859, they had guaranteed price contracts covering over 2,000 bales from 14 different plantations. They were storing 1,500 bales at any given time across 3 warehouses. They employed 8 full-time workers and maintained business relationships with buyers in 6 different cities. Henry had meanwhile expanded beyond cotton into general agricultural financing. Plantation owners increasingly came to the brothers not just for commodity trading, but for the kind of complex credit arrangements that would later define investment banking. They provided seasonal loans against future crops, financed equipment purchases, and even arranged mortgage financing for land acquisition. The mathematics of their lending operation demonstrated sophisticated risk management. Interest rates varied from 8% to 15%, depending on the plantation's credit history, crop diversification, and soil quality. They required collateral worth 150% of loan value and maintained detailed assessments of borrower creditworthiness. Emanuel's lending files read like modern credit analyses, tracking debt-to-asset ratios, cash flow patterns, and risk factors with remarkable precision. Look at this example from their 1859 files. William Morrison wanted to expand his plantation by purchasing an additional 500 acres for $2,500. The Lehman Brothers analyzed his existing 800 acres, which typically produced 400 bales annually, worth $4,800 at current prices. His operating costs were approximately $2,200 per year, leaving net income of $2,600. They calculated that the additional 500 acres would produce 250 additional bales worth $3,000, with operating costs of $1,400, generating additional net income of $2,600. The brothers approved a $2,500 loan at 12% annual interest, requiring annual payments of $300. Morrison's increased net income of $1,600 easily covered the debt service, while the additional land served as collateral. This wasn't just lending, this was sophisticated financial analysis that wouldn't become standard practice on Wall Street for another 20 years. But the real genius of the Lehman operation was how they integrated all these services. A plantation owner might start by buying goods from their store, then selling cotton to them at harvest, then borrowing money for expansion, then purchasing additional goods with the loan proceeds. The brothers weren't just serving customers, they were creating a complete financial ecosystem that generated multiple profit streams from each relationship. Mayer had calculated that their average customer generated profits through 4 different channels: retail markup on goods sold, 15–20%, commodity trading spreads, 10–15%, interest income on loans, 8–15%, and service fees for financial advice, 2–5%. By 1860, their most valuable customers generated combined profits of 25–30% annually on the brothers' invested capital. This integrated approach created powerful competitive advantages. Competitors might match them on individual services, but no one could replicate their comprehensive offering. A plantation owner who tried to piece together similar services from multiple providers would pay higher prices, receive less personalized attention, and lose the convenience of dealing with a single trusted partner. The numbers by 1860 were staggering. The Lehman Brothers controlled cotton inventory worth over $50,000, had outstanding loans totaling $35,000, and generated gross revenues approaching $100,000 annually. They employed 12 people and maintained business relationships that stretched from rural Alabama to London's financial district. 3 Jewish immigrants who had arrived with less than $1,000 now controlled more capital than most small banks. Their success hadn't gone unnoticed. Competitors throughout Alabama attempted to replicate their strategy, with limited success. The Lehman Brothers had built their network over 15 years, developing trust and expertise that couldn't be quickly duplicated. They had first-mover advantage in agricultural finance that created sustainable competitive moats. What nobody realized, including the brothers themselves, was that their entire empire was built on a foundation that was about to crumble. Cotton economics depended on slave labor. Alabama's agricultural system relied on an economy that was about to be challenged by political forces the brothers couldn't control or predict. Abraham Lincoln was elected president in November 1860. South Carolina seceded from the Union in December. By February 1861, 7 southern states had formed the Confederate States of America. War was inevitable. The Lehman Brothers faced a choice that would define their destiny: defend their Alabama empire, or abandon everything they had built to pursue opportunities in a rapidly changing America. They chose adaptation over preservation. It was the decision that would ultimately make them Wall Street royalty. Chapter 3. Moving North, April 12, 1861. Confederate artillery opened fire on Fort Sumter. The American Civil War had begun, and with it, the systematic destruction of everything the Lehman Brothers had built. Within months, Union naval blockades choked off cotton exports to Europe. Confederate currency became increasingly worthless as the South printed money to finance the war. Plantation owners who owed the brothers thousands of dollars could only pay in Confederate notes that lost value weekly. The sophisticated agricultural financing system the Lehmans had spent 15 years building was collapsing in real time. But while their competitors panicked, the Lehman Brothers saw opportunity in catastrophe. Emanuel had been tracking disturbing economic trends since Lincoln's election. Cotton prices in New York were rising not because of demand, but because of supply uncertainty. European textile mills were desperately seeking alternative suppliers. Meanwhile, northern manufacturers were experiencing unprecedented growth as the Union government ordered massive quantities of uniforms, weapons, and supplies. The brothers faced a brutal choice: stay in Alabama and hope the Confederacy survived, or abandon their empire and start over in Union territory. Most Alabama businessmen chose loyalty to the South. The Lehman Brothers chose profit over patriotism. Mayer made the decisive calculation. Their Alabama assets, warehouses, inventory, outstanding loans, and real estate were worth approximately $80,000 on paper. But these assets were becoming worthless as the Confederate economy collapsed. Meanwhile, their cotton trading expertise and financial skills were desperately needed in New York, where commodity markets were experiencing unprecedented volatility. In September 1862, Emanuel quietly traveled north to New York City. His mission was reconnaissance, evaluate opportunities, establish contacts, and determine whether the brothers could successfully transplant their operation. What he found exceeded every expectation. New York's financial district was experiencing explosive growth driven by war profiteering and government financing needs. The Union was spending over $2 million daily on the war effort, creating massive opportunities for anyone who understood government contracting, commodity trading, and financial intermediation. Banks were overwhelmed with business, and new investment houses were forming weekly to handle the unprecedented volume of transactions. Emanuel's intelligence gathering revealed that New York needed exactly what the Lehman Brothers offered: sophisticated commodity trading expertise, agricultural market knowledge, and experience managing complex credit relationships. Northern manufacturers were struggling to understand cotton markets disrupted by war. Government contractors needed financing to fulfill massive military orders. Investors were seeking opportunities in agricultural commodities as traditional securities became too risky. The brothers made their move in early 1863. Henry remained in Montgomery to liquidate their Alabama assets and collect outstanding debts. Emanuel and Mayer relocated to New York, establishing temporary offices at 78 Broad Street in Lower Manhattan. Their strategy was audacious: use their remaining capital and cotton market expertise to build a new empire in the financial capital of America. Their timing was perfect. Cotton prices had become incredibly volatile as war disrupted normal supply patterns. Prices fluctuated between $20 and $60 per bale, depending on military developments, weather reports, and speculation about war duration. This volatility created enormous opportunities for traders who understood the underlying markets. Mayer's first major transaction demonstrated their evolved sophistication. In March 1863, he learned that a Massachusetts textile manufacturer needed 200 bales of cotton immediately to fulfill a government uniform contract. The manufacturer was willing to pay $45 per bale, well above current market prices, but couldn't locate sufficient high-quality cotton. Using contacts developed during their Alabama years, Mayer arranged to purchase 200 bales from a Memphis trader for $32 per bale and resold them to the Massachusetts manufacturer for the full $45. The transaction generated $2,600 profit in 2 weeks with minimal capital investment. More importantly, It established the brothers as serious players in New York's cotton market. Emanuel simultaneously focused on developing relationships with Union government contractors. The War Department needed enormous quantities of supplies, uniforms, tents, blankets, medical supplies, and was willing to pay premium prices for reliable delivery. Contractors who could guarantee delivery often lacked the capital to purchase raw materials up front. This created perfect opportunities for the brothers' financing expertise. Their breakthrough came through a relationship with Marcus Goldman, a Jewish immigrant who had established a successful commercial paper business. Goldman introduced the brothers to several government contractors who needed short-term financing to bridge the gap between contract award and payment receipt. The Lehman Brothers began providing working capital loans to contractors at interest rates of 15 to 20% annually. Here's what made their lending operation so profitable. Government contracts provided excellent collateral because union payments, while often delayed, were virtually guaranteed. Contractors could assign their government receivables to the Lehman Brothers as security for loans. This eliminated traditional credit risks while generating substantial interest income. By late 1863, the brothers were financing over $200,000 in government contracts while maintaining active cotton trading operations. They had successfully transplanted their integrated business model from Alabama to New York, adapting agricultural financing expertise to war profiteering opportunities. But their real breakthrough was recognizing that New York's financial district was evolving beyond traditional banking towards something entirely new: investment banking. Wealthy individuals and institutions were seeking opportunities to invest in American economic growth, but they lacked expertise to evaluate opportunities or structure transactions. Meanwhile, growing businesses needed capital for expansion but couldn't access traditional bank loans. Emanuel identified this gap and proposed a revolutionary solution. The Lehman Brothers would serve as intermediaries, matching investors with businesses while earning fees for structuring transactions. This was the birth of investment banking in America, though it wouldn't be called that for another 20 years. Their first investment banking transaction involved a railroad company seeking capital to extend track from Buffalo to Cleveland. The company needed $500,000 but couldn't obtain bank financing because the project was considered too speculative. Emanuel structured a solution where wealthy investors would purchase railroad bonds paying 8% interest annually, with the bonds secured by both the railroad equipment and future revenue streams. The Lehman Brothers earned $25,000 in fees for structuring the transaction, while helping the railroad raise necessary capital. More importantly, they had discovered a business model that could generate enormous profits with relatively modest capital requirements. Instead of risking their own money on commodities or loans, they could earn fees for bringing together parties who needed each other. Henry's return from Alabama in late 1863 brought additional capital and completed their transition. He had successfully liquidated most of their southern assets, converting Confederate currency and outstanding debts into approximately $40,000 in Union currency. Combined with profits from their New York operations, the brothers now controlled over $100,000 in capital. This capital base enabled them to pursue larger opportunities. They began underwriting entire bond issues for growing companies, guaranteeing that businesses could raise necessary capital while earning substantial fees for their services. They expanded their government contract financing to include longer-term relationships with major suppliers. Most importantly, they began building the network of relationships with wealthy investors that would become the foundation of their Wall Street empire. Think about what the Lehman Brothers had accomplished in just 2 years. They had abandoned a successful regional business, relocated to America's most competitive financial market, and established themselves as significant players in multiple business lines. They had transformed from commodity traders into investment bankers, from regional merchants into New York financiers. The transition revealed the core characteristic that would define their success for the next 145 years. Adaptability combined with leverage. When their original business model became obsolete, they didn't try to preserve it. They identified new opportunities, applied their existing skills in new contexts, and used borrowed capital to accelerate their growth. By 1864, Lehman Brothers was generating over $300,000 in annual revenues from commodity trading, commercial lending, and investment banking. The three brothers who had lost everything in Alabama were well on their way to conquering Wall Street. But their greatest opportunities still lay ahead. The post-war American economy was about to experience unprecedented expansion, and the Lehman Brothers were positioned to profit from every aspect of that growth. Chapter 4. Wall Street. January 1868. Emanuel Lehman signed a lease for office space at 119 Liberty Street, just 2 blocks from the New York Stock Exchange. After 5 years of temporary locations and shared spaces, Lehman Brothers finally had a permanent address in the heart of America's emerging financial district. The move symbolized more than just stability. It represented the brothers' evolution from opportunistic war profiteers into legitimate Wall Street power brokers. But their real transformation was just beginning. Post-Civil War America was experiencing explosive economic growth. Railroad construction was expanding rapidly westward. Industrial manufacturing was replacing agricultural production as the primary driver of economic development. Most importantly, American businesses were growing beyond the capacity of traditional bank financing. They needed something new, access to capital markets through securities underwriting and trading. The Lehman Brothers understood this shift before most of their competitors. While established banks continued focusing on commercial lending and deposit services, the brothers positioned themselves at the intersection of growing businesses and wealthy investors seeking higher returns than bank deposits provided. Emanuel had spent months studying the operations of other emerging investment houses. He analyzed how Kuhn, Loeb & Coates structured railroad financing deals. He observed how J.P. Morgan was building relationships with industrial companies seeking capital. Most importantly, he studied the fee structures and profit margins that different types of transactions generated. His analysis revealed that investment banking was potentially far more profitable than their existing business lines. Commercial lending typically generated 8 to 12% annual returns on capital. Commodity trading, while lucrative, carried substantial risks and required significant capital investment. Investment banking, by contrast, could generate 15 to 25% fees on transaction value with minimal capital requirements. Here's what Emanuel discovered. The real money wasn't in taking financial risks, but in managing financial risks for others. Investment bankers earned fees for structuring transactions, bringing together buyers and sellers, and providing expertise that neither party possessed independently. The most successful firms focused on relationships and reputation rather than capital deployment. Mayer, meanwhile, had identified specific opportunities where Lehman Brothers could gain competitive advantage. Railroad companies needed massive capital infusions for track construction and equipment purchases. Department store chains were expanding rapidly and required financing for inventory and real estate. Manufacturing companies were investing in new production technology that exceeded their internal funding capacity. The brothers' breakthrough came through a relationship with Adam Gimbel, who was expanding his department store operations from Indiana into major eastern cities. Gimbel needed $200,000 to open stores in New York and Philadelphia, but traditional banks considered retail expansion too risky for large loans. Emanuel structured a revolutionary solution. Instead of a bank loan, Gimbel would issue bonds paying 7% annual interest that investors could purchase directly. The bonds would be secured by store inventory and real estate, providing protection for investors while giving Gimbel access to capital at reasonable rates. Lehman Brothers would underwrite the bond issue, guaranteeing that Gimbel could raise the full $200,000 while earning a $10,000 underwriting fee. The transaction was successful beyond expectations. Wealthy New York investors were eager for opportunities offering higher returns than government bonds or bank deposits. Gimbel's bonds sold quickly, providing him with necessary capital while generating substantial profits for investors. Most importantly, the transaction established Lehman Brothers as serious players in retail industry financing. Word of their success spread quickly through New York's business community. Within months, other department store owners approached them for similar financing arrangements. The brothers had discovered a profitable niche, providing capital market access to growing retail companies that traditional banks couldn't serve effectively. Henry's contribution was expanding their scope beyond retail into heavier industries. He developed relationships with railroad companies seeking capital for westward expansion. Railroad financing was enormously complex because projects required massive capital investments with uncertain returns dependent on future economic development along proposed routes. The brothers' first major railroad transaction involved the Kansas and Pacific Railroad, which needed $2 million to extend track from Kansas City to Denver. Traditional bank financing was impossible because the route traversed largely undeveloped territory with uncertain economic potential. But the federal government had granted land subsidies that provided substantial collateral value if the railroad could be completed successfully. Emanuel and Henry structured a complex financing arrangement that distributed risks among multiple parties while ensuring adequate returns for all participants. Wealthy investors would purchase railroad bonds secured by federal land grants and future revenue projections. The railroad would pay 8% annual interest and retain control over operations. Lehman Brothers would earn $100,000 in underwriting fees while helping coordinate the entire transaction. This deal demonstrated the brothers' sophisticated understanding of risk distribution and stakeholder management. Instead of asking investors to accept all risks of railroad development, they structured transactions that shared risks among investors, railroad companies, and government agencies. This approach made previously impossible projects financially feasible while generating substantial profits for all participants. But their most important innovation was developing systematic approaches to company valuation and credit analysis. Most investment houses relied on personal relationships and subjective judgments when evaluating potential clients. The Lehman Brothers created formal analytical frameworks that assessed companies based on financial performance, market position, management quality, and growth prospects. Mayer's analytical methods were particularly advanced for their time. He developed standardized financial ratios that allowed comparisons across different industries. He tracked historical performance patterns to identify companies with sustainable competitive advantages. Most importantly, he created risk assessment models that predicted which types of investments were most likely to generate consistent returns. Consider their analysis of R.H. Macy & Co. in 1869. Mayer's evaluation examined 5 years of sales and profit data, inventory turnover rates, location advantages, management track record, and competitive positioning. His analysis concluded that Macy's was undervaluing expansion opportunities and could profitably support additional debt financing for growth investments. The brothers proposed a $300,000 bond issue that would finance Macy's expansion into additional product lines and store locations. Their detailed financial analysis convinced investors that Macy's could easily service the debt while generating substantial returns. The transaction was successful, and Macy's subsequently became one of America's largest retail companies. These analytical capabilities gave Lehman Brothers substantial competitive advantages. While competitors relied on intuition and personal relationships, the brothers made decisions based on systematic financial analysis. This approach reduced their risks while identifying opportunities that others missed. By 1870, Lehman Brothers was underwriting over $5 million in securities annually, for clients ranging from railroad companies to department stores to manufacturing firms. They had built relationships with hundreds of wealthy investors seeking attractive returns and dozens of growing companies needing capital access. Their fee income was approaching $500,000 annually, more than many established banks earned from traditional lending operations. They employed 15 people and maintained offices that rivaled the most prestigious financial houses on Wall Street. 3 Jewish immigrants who had started with a fabric store in Alabama were now among the most influential investment bankers in America. But their success was creating new challenges and opportunities. American businesses were growing larger and more complex, requiring increasingly sophisticated financing arrangements. International investors were showing interest in American securities, creating opportunities for global capital raising. Most importantly, the federal government was considering financial regulations that could reshape the entire investment banking industry. The Lehman Brothers had established themselves as major players, but their greatest achievement still lay ahead. The late 19th century would bring opportunities for wealth accumulation and political influence, that would make them among the most powerful financiers in American history. Look, what they had accomplished by 1870 wasn't just business success, it was the creation of an entirely new American industry. Investment banking as we know it today was largely invented by firms like Lehman Brothers, who recognized that growing businesses needed access to capital markets rather than traditional bank loans. The brothers hadn't just adapted to changing economic conditions, they had helped create those conditions by developing new ways for money to flow from investors to businesses. They were building the financial infrastructure that would power American economic dominance for the next century. Chapter 5. Trading Empire. By 1875, Lehman Brothers controlled the largest private client network on Wall Street. Their client list read like a directory of American capitalism: Macy's, Gimbel Brothers, F.W. Woolworth, Sears Roebuck, May department stores. But these weren't just customers, they were partners in an integrated financial ecosystem that generated profits from every aspect of American retail expansion. Emanuel had revolutionized how investment banking actually worked. Instead of simply underwriting securities and earning one-time fees, Lehman Brothers created ongoing relationships that provided multiple revenue streams over decades. They didn't just help companies raise capital, they became their permanent financial advisors, earning fees for merger advice, acquisition financing, international expansion, and strategic planning. Take their relationship with R.H. Macy. Between 1869 and 1875, Lehman Brothers had underwritten 4 separate bond issues totaling $1.2 million for Macy's expansion. They earned $60,000 in underwriting fees, but that was just the beginning. They also provided ongoing financial advisory services, arranged short-term credit facilities, advised on real estate acquisitions, and structured compensation packages for senior executives. Mayer's innovation was turning investment banking into recurring revenue business. Traditional underwriters earned fees only when companies issued new securities. Mayer created retainer agreements where companies paid annual advisory fees in exchange for continuous access to Lehman Brothers' expertise and capital market connections. This retainer model was revolutionary because it aligned Lehman Brothers' interests with their clients' long-term success rather than short-term transaction volume. Instead of pushing unnecessary financings to generate fees, they focused on helping companies grow sustainably, which created more valuable long-term relationships. The numbers by 1875 demonstrated the power of this approach. Lehman Brothers earned over $200,000 annually from retainer fees alone, providing predictable income that didn't depend on market conditions or transaction timing. This steady revenue base enabled them to take larger risks on individual transactions while maintaining overall financial stability. But their real breakthrough was recognizing that American retail was experiencing structural transformation that would create unprecedented investment opportunities. Department stores were replacing small specialty shops. Chain stores were expanding across multiple cities. Mail-order catalogs were enabling retailers to serve customers nationwide. Mass production was reducing costs while improving product quality. Henry's insight was that these changes required enormous capital investments that far exceeded what individual companies could finance internally. Department stores needed money for inventory, real estate, and infrastructure. Chain stores required capital to open dozens of locations simultaneously. Mail-order companies needed warehouse facilities and distribution networks. Traditional banks couldn't serve these needs because retail loans were considered too risky and required specialized industry knowledge. Insurance companies had capital but lacked expertise to evaluate retail investments. Wealthy individuals wanted higher returns but needed professional management for complex transactions. Lehman Brothers positioned themselves as the essential bridge between capital and opportunity. They developed deep expertise in retail industry economics, created standardized valuation methods for retail companies, and built relationships with investors specifically interested in retail sector opportunities. Their most ambitious project was creating what they called retail investment pools. Instead of arranging individual transactions for separate companies, they would aggregate multiple retail investments into diversified portfolios that wealthy investors could purchase shares in. This approach reduced risks through diversification while enabling larger-scale investments than individual companies could support. The first retail investment pool, launched in 1876, raised $2 million from 25 wealthy investors to fund expansion of 5 different department store companies across 7 cities. Each investor purchased shares representing ownership in the entire portfolio rather than individual companies. Lehman Brothers managed the pool, earning 2% annual management fees plus 20% of profits above 10% annual returns. This structure was remarkably sophisticated for its time. Modern private equity firms use virtually identical models today, nearly 150 years later. The Lehman Brothers had essentially invented private equity investing decades before anyone called it that. The investment pool generated spectacular returns. Retail expansion was accelerating rapidly as urban populations grew and transportation networks improved. Department stores in the pool averaged 18% annual profit growth between 1876 and 1880. Investors earned average returns of 14% annually, while Lehman Brothers collected over $400,000 in management fees and performance bonuses. Word of their success spread quickly among New York's wealthy families. The Astors, Vanderbilts, and other prominent dynasties began investing substantial portions of their wealth through Lehman Brothers investment pools. This created enormous opportunities for the brothers to manage increasingly large amounts of capital, while earning fees based on performance rather than transaction volume. Emanuel's strategic vision expanded beyond retail into other industries experiencing similar transformation. Railroad construction was accelerating westward, creating opportunities for companies that provided equipment, materials, and services. Manufacturing was becoming increasingly mechanized, requiring capital for factory construction and machinery purchases. International trade was growing as steamship transportation reduced costs and delivery times. The brothers created specialized investment pools for each major industry sector. Railroad pools focused on equipment manufacturers and service companies rather than the railroads themselves, which were considered too risky for conservative investors. Manufacturing pools invested in companies producing industrial machinery, steel products, and other materials needed for economic expansion. International trade pools financed shipping companies, port facilities, and import-export businesses. By 1880, Lehman Brothers was managing over $15 million through various investment pools while maintaining their traditional underwriting and advisory businesses. They employed 43 people across multiple departments and maintained offices that occupied an entire floor at 119 Liberty Street. Their annual revenues exceeded $1.5 million, making them one of the most profitable financial firms in America. But Mayer's most important contribution was developing systematic approaches to risk management that enabled them to pursue larger opportunities without proportionally increasing dangers. He created formal investment committees that evaluated all major transactions using standardized criteria. He required detailed financial analysis for every investment, regardless of management's personal relationships with potential clients. Most importantly, he implemented diversification requirements that prevented any single investment from representing more than 10% of their total risk exposure. This approach protected them from catastrophic losses while enabling aggressive growth strategies. Consider their approach to railroad investments in the late 1870s. Railroad companies were expanding rapidly, but many projects failed due to unrealistic projections, poor management, or economic downturns. Instead of avoiding the sector entirely, Lehman Brothers invested in dozens of smaller companies that provided services to railroads rather than a few railroad companies directly. They financed companies that manufactured railroad equipment, provided construction services, operated grain elevators along railroad routes, and developed real estate in railroad towns. This approach captured the profits from railroad expansion while avoiding the risks of individual railroad failures. Their diversified railroad portfolio included investments in locomotive manufacturers, steel rail producers, railroad car companies, bridge construction firms, and telegraph companies that provided communication along railroad routes. When several major railroads failed in the 1877 economic downturn, Most of these service companies continued operating profitably because they served multiple railroad clients. The strategy was brilliantly successful. Their railroad service portfolio generated average returns of 16% annually between 1877 and 1885, while direct railroad investments averaged only 3% annually due to widespread failures and bankruptcies. This risk management sophistication enabled Lehman Brothers to pursue opportunities that competitors avoided while maintaining superior safety records. They could offer investors higher returns with lower risks because they understood how to structure and diversify investments more effectively than anyone else on Wall Street. Look, what the Lehman Brothers had created by 1880 wasn't just an investment bank. It was America's first modern asset management firm. They were managing money for wealthy families, creating diversified investment portfolios, earning fees based on performance, and providing comprehensive financial services that didn't exist anywhere else. Their success was creating political influence that would shape American financial policy for decades. Emanuel served on various government committees, advising on banking regulations. Henry maintained relationships with senior politicians from both parties. Mayer's economic analyses were regularly cited in congressional debates about monetary policy. The three Jewish immigrants who had started with less than $1,000 now controlled tens of millions in client assets and wielded influence that extended far beyond Wall Street. They had become American financial aristocracy, but their greatest achievements still lay ahead. The 1880s and 1890s would bring opportunities for wealth accumulation that would make them among the richest families in American history. Chapter 6. Global Expansion. Emanuel Lehman stepped off a steamship at Southampton, carrying letters of introduction to London's most prestigious banking houses and a mandate to establish Lehman Brothers as a global financial power. European capital was flowing into American investments at unprecedented rates. British, German, and French investors were eager for higher returns than their domestic markets provided, but they needed trustworthy American partners who understood both European expectations and American opportunities. Emanuel's 3-month European tour revealed enormous opportunities that most American investment banks were ignoring. European investors controlled vast amounts of capital seeking global diversification, but they lacked reliable information about American investments. European banks wanted to finance American economic expansion, but needed local partners who could evaluate opportunities and manage risks. Most importantly, Emanuel discovered that European investors were willing to pay premium fees for professional investment management services that barely existed in European financial markets. Wealthy European families were accustomed to managing their own investments or relying on traditional banks that offered limited expertise in foreign markets. The opportunity was clear. Lehman Brothers could serve as intermediary between European capital and American investments, while introducing European investors to sophisticated investment management services that were becoming standard in America. Emanuel's first breakthrough came through a relationship with N.M. Rothschild & Sons, Europe's most influential banking house. The Rothschilds had accumulated enormous wealth through government bond trading and currency speculation, but they were seeking diversification into private sector investments with higher growth potential. James de Rothschild was particularly interested in American railroad and industrial development, but lacked expertise to evaluate specific investment opportunities. He proposed a partnership where Rothschild would provide capital, while Lehman Brothers would identify, structure, and manage American investments. The partnership began with a $5 million investment pool focused on American industrial companies that supplied materials and equipment for railroad construction. Lehman Brothers would receive 2% annual management fees plus 25% of profits above 12% annual returns. More importantly, the Rothschild relationship provided credibility that opened doors to other European banking houses. Mayer's analytical expertise was crucial for managing European capital successfully. European investors expected detailed reporting and risk analysis that exceeded what most American companies provided. Mayer created comprehensive investment reports that tracked financial performance, competitive position, management quality, and market conditions for every portfolio company. These reports weren't just for client communication. They enabled Lehman Brothers to identify problems early and intervene before small issues became major losses. When one of their portfolio companies experienced declining sales, Mayer's analysis revealed that the problem was poor inventory management rather than market conditions. Lehman Brothers arranged new management and additional working capital, turning around the company's performance within 6 months. Henry, meanwhile, focused on developing relationships with German banking houses, which controlled substantial capital but had limited American investment experience. German banks were particularly interested in manufacturing investments because they understood industrial operations better than railroad or retail opportunities. His breakthrough came through Deutsche Bank, which wanted to invest in American steel production but lacked knowledge about American markets, regulations, and competitive conditions. Henry arranged a $3 million investment in Pennsylvania steel companies that supplied materials for railroad construction and urban infrastructure development. The German investments were structured differently from British partnerships. Instead of investment pools, German banks preferred direct ownership stakes in American companies, with Lehman Brothers providing ongoing management services. This approach required more intensive oversight, but generated higher fees and provided greater control over investment performance. But their most ambitious international project was establishing permanent European offices that could serve European clients directly, rather than managing everything from New York. In 1886, Emanuel opened Lehman Brothers London at 15 Moorgate Street, with Meyer establishing a smaller Frankfurt office that served German and Austrian clients. The European offices weren't just sales operations. They were full-service investment management firms that provided Europeans with access to American opportunities while offering Americans with access to European capital. European clients could invest in American securities through London, while American companies could raise capital from European investors through the same offices. This integrated approach created powerful competitive advantages. American companies preferred working with Lehman Brothers for European fundraising because they offered comprehensive services rather than simple introductions. European investors chose Lehman Brothers for American investments because they provided professional management and detailed reporting that other American firms couldn't match. The numbers by 1890 demonstrated the success of their global strategy. European clients had invested over $25 million through Lehman Brothers offices, generating annual management fees exceeding $750,000. The London office employed 12 professionals and managed investments for over 40 European families and institutions. More importantly, their European connections enabled them to pursue larger American opportunities than their domestic capital alone could support. When Sears Roebuck needed $2 million for nationwide expansion in 1889, Lehman Brothers arranged financing that combined American and European capital, enabling them to undertake the transaction while diversifying risks across multiple investor groups. Emanuel's strategic insight was recognizing that global capital flows were permanently changing how investment banking worked. American economic growth was attracting international attention, but foreign investors needed local expertise to participate successfully. Meanwhile, American companies needed access to global capital markets to fund expansion opportunities that exceeded domestic financing capacity. Lehman Brothers positioned themselves at the center of these capital flows by developing genuine expertise in cross-border investment management. They weren't just arranging transactions, they were building permanent relationships with wealthy families and institutions that generated recurring revenue streams for decades. Consider their relationship with the Warburg family, prominent German bankers seeking American investment opportunities. Between 1886 and 1895, Lehman Brothers managed over $8 million in Warburg family investments across railroad, manufacturing, and retail companies. The relationship generated over $400,000 in management fees, while establishing connections that proved valuable for future European fundraising activities. But their international success created new challenges. Managing investments across multiple countries required sophisticated communication systems, currency hedging strategies, and compliance with different regulatory frameworks. Most importantly, It required developing trust with clients they might meet only occasionally while managing their money from thousands of miles away. Mayer's solution was creating the most comprehensive client reporting system in international finance. European clients received monthly investment reports, quarterly performance summaries, and annual strategic assessments that detailed every aspect of their American investments. These reports included financial statements, market analysis, management evaluations, and forward-looking projections that enabled clients to make informed decisions about their investments. The reporting system wasn't just about client service, it created powerful information advantages for Lehman Brothers. Tracking dozens of companies across multiple industries provided insights into economic trends, competitive dynamics, and market conditions that enabled them to identify opportunities and avoid problems more effectively than competitors who focused on individual transactions. Their international operations also provided valuable hedging against American market downturns. When the American economy experienced recession in 1893, their European clients provided stability that enabled them to maintain operations and pursue opportunities that competitors couldn't afford during difficult market conditions. By 1895, Lehman Brothers was managing over $50 million in combined American and European investments, making them one of the largest private asset management firms in the world. They employed over 60 professionals across New York, London, and Frankfurt offices. Their annual revenues exceeded $2 million, with approximately 40% generated from international operations. Look at what they had accomplished in just 11 years. They had transformed from a domestic American investment bank into a global financial institution that served wealthy families and institutions across 3 continents. They had created permanent relationships with European capital that provided access to virtually unlimited financing for American investments. Most importantly, they had developed operational capabilities that enabled them to manage complex international transactions while maintaining the personal service and risk management standards that defined their success. They weren't just growing larger, they were becoming more sophisticated and more valuable to their clients. The Lehman Brothers had proven that with sufficient intelligence, ambition, and execution capability, American financial firms could compete successfully with the most established European banking houses. They had globalized their business while maintaining the relationship-focused approach that distinguished them from larger competitors. Their success was creating political influence that extended beyond Wall Street into international financial policy. Emanuel served on government committees that advised on currency policy and international trade agreements. Henry maintained relationships with senior officials in European governments. Their economic analyses were regularly cited in policy debates about financial regulation and international investment flows. By 1895, 3 Jewish immigrants who had started with a fabric store were among the most influential financial figures in the Atlantic economy. Chapter 7. Mortgage Madness. Richard Full Jr. stood before Lehman Brothers' board of directors with a proposal that would fundamentally transform the 151-year-old firm, aggressive expansion into mortgage-backed securities. The Lehman Brothers who built the firm were long dead. Henry died in 1855, Emanuel in 1907, Mayer in 1897. Their descendants had sold the company to American Express in 1984, but Fuld had led a management buyout in 1994 that restored Lehman's independence. Now he wanted to rebuild the firm around a revolutionary financial innovation that would make their railroad and retail financing look primitive by comparison. Mortgage-backed securities represented the logical evolution of everything the original Lehman Brothers had pioneered, turning illiquid assets into tradable securities, using leverage to amplify returns, and creating new financial products that connected borrowers with investors. But the scale and complexity of modern mortgage financing exceeded anything the 19th century financial markets had imagined. Here's how the system worked. Banks would originate thousands of individual home mortgages, then sell them to investment banks like Lehman Brothers. The investment banks would package hundreds or thousands of mortgages together into securities that could be sold to investors worldwide. This process, called securitization, enabled banks to lend more money while providing investors with diversified exposure to American real estate markets. Fuld's insight was that Lehman Brothers could dominate this market by controlling every aspect of the securitization process. Instead of just packaging mortgages originated by other banks, they would originate mortgages directly, package them into securities, sell them to investors, and provide ongoing servicing. This integrated approach would generate profits from multiple revenue streams while creating competitive advantages that would be difficult for competitors to replicate. The strategy required massive capital investments and sophisticated risk management systems. Lehman Brothers would need to hire hundreds of mortgage originators, develop technology systems for processing thousands of loans monthly, create trading desks for managing interest rate risks, and establish relationships with investors worldwide who would purchase their securities. But the profit potential was enormous. Mortgage origination generated fees of 1 to 2% of loan value. Securitization earned additional fees of 0.5 to 1%. Trading margins added another 0.25 to 0.5%. Servicing provided ongoing revenue streams of 0.25% annually. A mortgage that generated $3,000 in total fees for traditional banks could generate $8,000, $12,000 in fees for an integrated operation like Fooled envisioned. By 1998, Lehman Brothers had invested over $500 million in building the most sophisticated mortgage platform on Wall Street. They employed over 2,000 mortgage professionals across 43 offices nationwide. Their technology systems could process over 10,000 mortgage applications monthly while maintaining detailed tracking of credit quality, interest rate exposure, and geographic diversification. Their securitization operation was particularly advanced. Traditional mortgage securities simply passed through principal and interest payments from underlying mortgages to investors. Lehman Brothers created more complex structures that provided different risk and return profiles for different types of investors. For example, their senior subordinate structures divided mortgage payments into multiple tranches with different priority levels. Senior tranches received priority for principal and interest payments, making them safer but offering lower returns. Subordinate tranches absorbed losses first, making them riskier but offering higher returns. This structure enabled conservative investors like pension funds to purchase senior tranches, while aggressive investors like hedge funds purchased subordinate tranches. Mayor Lehman would have recognized the genius of this approach. Just as the original brothers had turned cotton futures into financial instruments, Fooled was turning home mortgages into sophisticated investment products that could serve multiple investor types simultaneously. The business was spectacularly profitable. Between 1998 and 2003, Lehman Brothers mortgage operations generated over $8 billion in revenues while requiring relatively modest capital investments. Their return on equity for mortgage operations exceeded 25% annually, far higher than traditional investment banking activities. But success created pressure for continued growth that began pushing the firm toward increasingly risky strategies. Mortgage demand was finite, and competitors were aggressively expanding their own securitization operations. To maintain growth rates, Lehman Brothers needed to either capture market share from competitors or expand into previously untapped markets. They chose expansion into subprime mortgages, loans to borrowers with poor credit histories who couldn't qualify for traditional financing. Subprime mortgages offered higher interest rates that generated larger securitization profits, but they also carried substantially higher default risks. The firm's risk management initially imposed strict guidelines on subprime lending. Borrowers needed minimum credit scores of 620, down payments of at least 10%, and debt-to-income ratios below 35%. These requirements eliminated many potential borrowers, but ensured that subprime mortgages remained relatively safe investments. However, competitive pressure gradually eroded these standards. Other firms were originating subprime mortgages with lower credit requirements and higher loan-to-value ratios. To compete effectively, Lehman Brothers began reducing their underwriting standards while convincing themselves that diversification and sophisticated risk modeling would protect them from significant losses. By 2005, Lehman Brothers was originating mortgages to borrowers with credit scores below 600, no down payments, and no verification of income or assets. These ninja loans, no income, no job, no assets verification, generated enormous fees, but represented unprecedented risks that the firm's risk models couldn't accurately assess. The original Lehman Brothers had succeeded because they understood the underlying economics of their investments. They knew cotton markets intimately, analyzed plantation operations carefully, and maintained conservative leverage ratios that protected them during market downturns. The modern Lehman Brothers was operating mortgage businesses they didn't fully understand while employing leverage ratios that would have horrified their predecessors. Consider their approach to risk assessment. Traditional mortgage underwriting evaluated borrowers' ability to repay loans based on income, credit history, and asset levels. Modern securitization enabled Lehman Brothers to originate mortgages without retaining credit risk because they sold mortgages to investors immediately after origination. This originate-to-distribute model theoretically transferred risks from Lehman Brothers to investors who purchased their securities. But in practice, the firm retained substantial risks through several mechanisms. They provided representations and warranties about loan quality that created legal liabilities if mortgages performed poorly. They held subordinate tranches of their own securitizations to convince investors that senior tranches were safe, and they maintained warehouse lines of credit that financed mortgage origination before securitization. More importantly, their reputation depended on maintaining investor confidence in their securitization products. If their mortgages experienced higher than expected default rates, investors would stop purchasing future securitizations, destroying the profitability of their entire mortgage platform. But the firm's management convinced themselves that sophisticated risk models and geographic diversification would protect them from significant losses. They developed complex mathematical models that predicted mortgage default rates based on historical performance patterns. They ensured that their securitizations included mortgages from dozens of different geographic markets to reduce concentration risks. What they failed to recognize was that their models were based on historical periods when mortgage underwriting standards were much more conservative. They had no data about how ninja loans would perform during housing market downturns, because such loans had never been originated at scale during previous market cycles. By 2006, Lehman Brothers had securitized over $200 billion in subprime mortgages, while retaining approximately $40 billion in direct exposure through subordinate tranches, warehouse facilities, and legal representations. They were earning over $3 billion annually from mortgage operations, representing nearly 40% of the firm's total revenues. Their leverage ratio had increased to 32-to-1, meaning they had borrowed $32 for every dollar of capital. This leverage amplified their mortgage profits during good times, but it also meant that relatively small losses could eliminate their entire capital base. The firm's success created a culture of risk-taking that gradually replaced the careful analysis and conservative leverage that had defined the Lehman Brothers for over 150 years. Senior executives received compensation packages tied to short-term revenue growth rather than long-term risk management. Junior employees were rewarded for originating larger volumes of mortgages, regardless of credit quality. Look, what happened between 1995 and 2006 represented a fundamental departure from the principles that had enabled the Lehman Brothers to survive for over a century. The original brothers had succeeded by understanding their investments intimately, maintaining conservative leverage, and adapting gradually to changing market conditions. The modern Lehman Brothers was pursuing growth strategies they didn't fully understand, employing leverage ratios that eliminated their margin for error, and ignoring warning signs that their risk models might be fundamentally flawed. But the profits were so enormous, and the competitive pressures so intense that stopping seemed impossible. Everyone on Wall Street was pursuing similar strategies. Government regulators were encouraging home ownership expansion. Rating agencies were providing favorable ratings for mortgage securities. Investors worldwide were eager to purchase higher-yielding American mortgage products. By late 2006, Lehman Brothers had transformed from a diversified investment bank into a highly leveraged mortgage company. Mortgage operations generated over 60% of their revenues and consumed over 80% of their capital. They had bet the entire firm on the assumption that American housing prices would continue rising indefinitely. It was exactly the kind of concentrated risk that Meyer Lehman's diversification requirements had been designed to prevent. But those requirements had been abandoned in pursuit of growth rates that would have seemed impossible to the original founders. The stage was set for the most spectacular financial collapse in American history. Chapter 8. Warning Signs. February 2007. Housing prices in California, Florida, and Nevada began declining for the first time in 15 years. For most Americans, this seemed like a natural market correction after years of unsustainable price increases. For Lehman Brothers, it was the beginning of the end. The firm's mortgage operations had been built on a fundamental assumption. Housing prices might fluctuate occasionally, but they would never decline significantly on a national scale. This assumption wasn't just hope. It was embedded in every risk model, every securitization structure, and every leverage calculation that underpinned their $40 billion mortgage portfolio. David Goldfarb, Lehman's chief risk officer, had been raising concerns about their mortgage exposure since late 2005. His analysis suggested that their risk models underestimated potential losses during housing market downturns because they were based on limited historical data from periods when mortgage underwriting was much more conservative. Goldfarb's reports to senior management were increasingly urgent. The firm was originating mortgages with credit standards that had never been tested during market stress periods. Their leverage ratio of 32-1 provided no cushion for unexpected losses. Most importantly, their mortgage revenues had become so large that even modest credit losses could eliminate the firm's entire capital base. But Richard Full dismissed these warnings. The mortgage business was generating over $4 billion in annual revenues and had driven the firm's stock price from $50 in 1994 to over $80 in early 2007. Competitors who had avoided aggressive mortgage expansion were being punished by investors for missing growth opportunities. Regulatory authorities were encouraging continued mortgage expansion to support homeownership goals. The first concrete warning sign came in March 2007 when New Century Financial, one of the largest subprime mortgage originators, filed for bankruptcy. New Century had pursued strategies similar to Lehman Brothers: aggressive growth in subprime lending, high leverage ratios, and heavy reliance on securitization for profitability. Emanuel, Lehman's head of quantitative research, conducted an analysis of New Century's failure that revealed disturbing parallels to Lehman's own operations. New Century had maintained leverage ratios above 30-1, concentrated heavily in subprime mortgages, and relied on continued securitization activity for liquidity. When mortgage default rates increased and securitization markets froze, New Century couldn't fund operations and collapsed within weeks. Derman's analysis concluded that Lehman Brothers faced similar risks, but on a much larger scale. Their mortgage portfolio was nearly 3 times larger than New Century's, their leverage ratio was comparable, and their dependence on securitization revenues was even greater. If mortgage markets experienced serious stress, Lehman could face liquidity problems that might threaten the firm's survival. Full's response was to increase mortgage origination efforts while expanding into new geographic markets that hadn't yet experienced price declines. His reasoning was that diversification across more markets would reduce concentration risks while maintaining revenue growth necessary to service their debt obligations. This strategy required even higher leverage ratios to generate sufficient returns. By mid-2007, Lehman Brothers' leverage had increased to 35-1, meaning they had borrowed $35 for every dollar of capital. They were operating with thinner capital cushions than any major investment bank in American history. The second major warning came in June 2007, when Bear Stearns announced that 2 of its hedge funds heavily invested in mortgage securities were facing massive losses. The Bear Stearns funds had employed leverage ratios above 100-1 while investing in mortgage securities similar to those in Lehman's portfolio. When mortgage default rates increased beyond historical norms, the funds couldn't meet margin calls from their lenders and were forced to liquidate positions at fire sale prices. Within days, $1.6 billion in investor capital was essentially eliminated, and Bear Stearns was forced to inject $3.2 billion to prevent complete collapse of the funds. Christine Daly, Lehman's treasurer, recognized that the Bear Stearns situation demonstrated how quickly mortgage investments could lose value during market stress. She recommended immediately reducing the firm's mortgage exposure and decreasing leverage ratios to more conservative levels. Her analysis showed that Lehman Brothers held approximately $85 billion in mortgage-related assets, financed with short-term borrowing that needed to be renewed constantly. If lenders became concerned about the firm's mortgage exposure, they could refuse to renew financing arrangements, forcing Lehman to sell mortgage assets at distressed prices similar to the Bear Stearns funds. But reducing mortgage exposure would require recognizing substantial losses because mortgage securities had already declined significantly in value. Gould calculated that deleveraging would force them to report quarterly losses that might trigger credit rating downgrades, making their funding problems even worse. Instead, Gould chose a strategy that the original Lehman Brothers would have recognized as catastrophically dangerous, doubling down on mortgage investments while hoping that market conditions would improve. Between June and September 2007, Lehman Brothers actually increased their mortgage holdings by purchasing distressed assets from competitors at what they believed were attractive prices. Their reasoning was that mortgage securities were temporarily undervalued due to market panic rather than fundamental credit problems. They believed their superior analytical capabilities would enable them to identify high-quality mortgage investments while avoiding the credit problems that had destroyed competitors. This analysis was fundamentally flawed. Mortgage securities weren't declining because of temporary market panic. They were declining because underlying credit assumptions had been systematically wrong. Subprime borrowers were defaulting at rates that exceeded even pessimistic projections. Housing prices were declining in markets that had never experienced significant price declines. Most importantly, the entire securitization system was breaking down as investors lost confidence in rating agencies and risk models. Mayor Lehman's risk management principles would have demanded immediate portfolio diversification and leverage reduction when faced with such clear warning signals. But those principles had been abandoned in pursuit of short-term profit maximization that ignored long-term survival considerations. The third major warning came in August 2007, when several European banks announced massive losses from American mortgage investments. BNP Paribas suspended redemptions from 3 investment funds because they couldn't accurately value their mortgage holdings. IKB Deutsche Industrie Bank required a $3.5 billion bailout due to mortgage-related losses. These European losses demonstrated that mortgage problems weren't confined to subprime lenders or American markets. High-quality international institutions had suffered enormous losses from mortgage securities that rating agencies had classified as safe investments. The entire global financial system was discovering that mortgage risk models had been systematically wrong. But instead of recognizing these warning signals, Lehman Brothers continued pursuing growth strategies that increased their exposure to exactly the risks that were destroying their competitors. They convinced themselves that their superior risk management and analytical capabilities would enable them to succeed where others had failed. By September 2007, Lehman Brothers held over $110 billion in mortgage-related assets, financed with leverage ratios approaching 40 to 1. They were earning over $1 billion quarterly from mortgage operations, but they were also exposed to potential losses that could eliminate the firm's entire $25 billion capital base if mortgage markets continued deteriorating. The firm's quarterly reports to investors portrayed their mortgage operations as profitable growth businesses rather than acknowledging the substantial risks they created. Senior executives received bonuses based on mortgage revenues while ignoring mounting evidence that those revenues were unsustainable. Internal risk reports were increasingly pessimistic, but they were either ignored by senior management or dismissed as overly conservative. The firm had created a culture where questioning mortgage strategy was seen as disloyalty rather than prudent risk management. Consider this email from a senior risk manager to Richard Gould in October 2007. Our mortgage exposure now represents 4.5x our total capital base. Historical data suggests that mortgage losses during severe market stress could exceed 10 to 15% of portfolio value. Simple mathematics indicates that significant mortgage losses could eliminate our capital base entirely. Phil's written response was revealing. "We have the best mortgage professionals on Wall Street and the most sophisticated risk management systems in the industry. Our competitors are failing because they lack our analytical capabilities and risk controls. This is exactly the time to increase our market share while others retreat." This response demonstrated how successful risk-taking can create dangerous overconfidence. The Lehman Brothers had survived numerous market crises over 163 years by maintaining conservative leverage and diversified operations. But recent mortgage profits had convinced management that traditional risk management principles no longer applied to their sophisticated operations. Look, what happened during 2007 wasn't just poor judgment. It was systematic abandonment of risk management principles that had enabled the firm to survive for over a century and a half. The original Lehman Brothers had succeeded by adapting gradually to changing conditions while maintaining conservative financial structures. The modern Lehman Brothers was ignoring clear warning signals while doubling down on concentrated risks that threatened the firm's survival. They had convinced themselves that their recent success proved their invincibility rather than recognizing that it might indicate they were taking unsustainable risks. By the end of 2007, Lehman Brothers faced a choice that would determine their survival: acknowledge mortgage losses and reduce leverage ratios, or continue pursuing growth strategies that offered enormous potential returns but also catastrophic risks. They chose to roll the dice one more time. Chapter 9: Final Gamble. January 2008. Richard Fuld called an emergency meeting with Lehman Brothers Executive Committee. The firm had just reported its first quarterly loss since going public, $2.8 billion, driven entirely by mortgage-related write-downs. The quarterly loss was devastating, but the underlying situation was even worse. Lehman Brothers' mortgage portfolio had declined by over $15 billion in value during the fourth quarter of 2007. They had recognized only $2.8 billion in losses while keeping the remainder on their books at prices that no rational buyer would pay. This accounting strategy, known as extend and pretend, was becoming common across Wall Street. Firms were avoiding massive write-downs by arguing that mortgage securities were temporarily undervalued due to market panic rather than permanently impaired by credit problems. They valued illiquid mortgage assets using internal models rather than observable market prices. But Lehman's situation was uniquely dangerous because their leverage ratios left no room for additional losses. They had borrowed nearly $40 for every dollar of capital, meaning that mortgage write-downs of just 3% would eliminate their entire equity base. They were operating with leverage ratios that made survival dependent on mortgage markets recovering quickly. Fuld's strategy was to maintain their mortgage positions while aggressively raising additional capital to strengthen their balance sheet. In March 2008, Lehman Brothers announced that they had raised $4 billion from new investors at $32 per share, a 40% discount to their recent stock price. The capital raising was supposed to demonstrate confidence in Lehman's long-term prospects, while providing additional cushion for mortgage losses. Instead, it created more questions about the firm's financial condition. Sophisticated investors wondered why Lehman was willing to sell shares at such steep discounts if management truly believed their mortgage assets were undervalued. More troubling was the identity of their new investors. Instead of attracting blue-chip institutions or sovereign wealth funds, Lehman was forced to accept capital from relatively unknown investors who demanded preferred shares with guaranteed dividend payments. These investors weren't betting on Lehman's recovery. They were seeking high-yield investments with downside protection. Timothy Geithner, president of the New York Federal Reserve, began conducting confidential meetings with major investment banks to assess their financial stability. His analysis of Lehman Brothers revealed that their reported capital ratios significantly overstated their true financial strength because they were based on inflated asset valuations. Geithner's team calculated that Lehman's mortgage assets were worth approximately 60 and 70% of their reported book value, implying additional losses of $20 to $30 billion that hadn't been recognized. If these losses were acknowledged, Lehman Brothers would be technically insolvent with negative equity of $5 to $15 billion. The Federal Reserve's analysis was based on market prices for similar mortgage securities that were actually trading, rather than the theoretical models that Lehman used for internal valuations. This mark-to-market analysis suggested that virtually every major investment bank was significantly undercapitalized, but Lehman's situation was the most precarious. Bear Stearns' collapse in March 2008 provided a preview of what could happen to highly leveraged investment banks during periods of market stress. Bear Stearns had maintained leverage ratios similar to Lehman's while holding substantial mortgage portfolios. When confidence evaporated, Bear's funding sources disappeared within days, forcing an emergency sale to J.P. Morgan Chase for $2 per share. The Bear Stearns collapse should have convinced Lehman Brothers to immediately reduce leverage and recognize mortgage losses before their situation became equally desperate. Instead, Fuld interpreted Bear's failure as an opportunity to gain market share while competitors were distracted by their own problems. Between April and June 2008, Lehman Brothers actually increased their proprietary trading activities while maintaining their mortgage positions. They convinced themselves that Bear Stearns had failed due to poor management rather than fundamental problems with the investment banking business model during mortgage crises. This analysis was dangerously wrong. Bear Stearns had employed sophisticated risk management systems and experienced professionals. They failed because no investment bank could survive the combination of massive mortgage losses and extreme leverage ratios during a liquidity crisis. Lehman Brothers faced exactly the same fundamental vulnerabilities. Erin Callan, Lehman's chief financial officer, spent months conducting conference calls with investors and rating agencies to convince them that the firm's mortgage problems were manageable. Her presentations emphasized Lehman's diversified business model, experienced management team, and strong client relationships. But investors were focusing on simpler questions. How much additional capital would Lehman need if mortgage losses continued? Could they survive if funding markets remained stressed for extended periods? Most importantly, why should anyone believe that Lehman's mortgage valuations were accurate when similar assets were trading at much lower prices? Callan's responses became increasingly defensive as mortgage markets continued deteriorating. She argued that Lehman's mortgage assets were higher quality than those held by competitors, that their internal valuations were based on sophisticated analytical models, and that current market prices didn't reflect long-term fundamental values. These arguments weren't necessarily wrong, but they were irrelevant to Lehman's survival. Investment banks depend on short-term funding that must be renewed constantly. If lenders lose confidence in a firm's financial stability, they will refuse to provide financing, regardless of whether the firm's assets might recover value over multiple years. The firm's credit rating became crucial because many funding sources were restricted from lending to institutions below investment grade. Moody's and Standard & Poor's had maintained Lehman's A ratings despite growing concerns about their mortgage exposure, but both agencies were conducting intensive reviews that could lead to downgrades. A credit rating downgrade would create a death spiral for Lehman Brothers. Lower ratings would force them to post additional collateral for derivatives transactions while increasing their borrowing costs. Many institutional lenders would be prohibited from providing financing to below investment grade borrowers. Most importantly, a downgrade would signal to markets that even rating agencies had lost confidence in Lehman's survival prospects. Fuld's response was to aggressively lobby rating agencies while threatening to move Lehman's business to agencies that provided more favorable ratings. This strategy backfired because it convinced rating agencies that Lehman's management wasn't serious about addressing their underlying problems. By August 2008, Lehman Brothers faced a countdown to catastrophe. Their second quarter results showed continued mortgage losses despite aggressive accounting that minimized write-downs. Their stock price had declined to $15, down over 80% from its 2007 peak. Most importantly, their funding costs were increasing as lenders demanded higher interest rates to compensate for perceived risks. The firm had three basic options: raise substantial additional capital, find a merger partner, or attempt to survive independently while hoping mortgage markets recovered. Each option carried enormous risks and uncertain prospects for success. Raising capital at current stock prices would require massive dilution that might eliminate existing shareholders entirely. Potential investors were demanding preferred shares with guaranteed dividends and liquidation preferences that would further weaken the firm's capital structure. Finding a merger partner required admitting that Lehman Brothers couldn't survive independently, while accepting a sale price that would represent massive losses for shareholders. Potential buyers were conducting detailed due diligence that revealed the full extent of Lehman's mortgage problems. Attempting independent survival required hoping that mortgage markets would stabilize before Lehman's capital was completely exhausted. This strategy carried the highest potential rewards but also the greatest risks of complete collapse. Emanuel Lehman would have immediately chosen the merger option because survival was always more important than pride or short-term financial considerations. The original Lehman Brothers had abandoned their entire Alabama operation during the Civil War rather than risking everything on uncertain outcomes. But Fuld chose to fight for independence while desperately seeking capital from sovereign wealth funds, private equity firms, and foreign banks. He convinced himself that Lehman Brothers was too important to fail and that government authorities would intervene to prevent collapse if private solutions weren't available. This assumption would prove fatally wrong. The federal government had decided that moral hazard concerns required allowing at least one major investment bank to fail as an example to others. Lehman Brothers was the logical choice because they were the most over-leveraged and had shown the least willingness to address their problems proactively. By September 2008, Lehman Brothers was operating on borrowed time with borrowed money, while management desperately searched for solutions to problems they had spent months denying. They had less than $25 billion in capital to support over $700 billion in assets and obligations. The final gamble was about to end in total defeat. Chapter 10, Black Monday, September 15, 2008, 1:45 a.m. Richard Fuld stood alone in his corner office, watching Manhattan's lights flicker below. In 4 hours, Lehman Brothers Holdings, Inc. would file the largest bankruptcy in American history. The weekend had been a desperate 48-hour scramble to find a last-minute solution. Bank of America had briefly considered purchasing Lehman Brothers, but walked away when due diligence revealed mortgage losses that exceeded even pessimistic estimates. Barclays had negotiated seriously until British regulators refused to approve the transaction without government guarantees that weren't forthcoming. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke had made a definitive decision. No government bailout would be provided. They argued that moral hazard required allowing at least one major investment bank to fail as a lesson to others about excessive risk-taking. Lehman Brothers would be that example. The decision was influenced by political considerations. Bear Stearns had been rescued in March through an arranged marriage with J.P. Morgan Chase that cost taxpayers $29 billion. AIG would require a government bailout within days that would eventually reach $180 billion. Public anger about Wall Street bailouts was reaching dangerous levels, and politicians needed to demonstrate that consequences existed for reckless behavior. Fuld had spent Sunday night calling everyone with potential influence: former Treasury secretaries, Federal Reserve Board members, senior White House officials, congressional leaders from both parties. His message was consistent: Lehman Brothers was too interconnected to fail without triggering global financial catastrophe. Their bankruptcy would destroy confidence in the entire investment banking system while creating losses for thousands of institutional investors worldwide. These arguments weren't wrong, but they were irrelevant to political calculations. The Bush administration was entering its final months and couldn't risk additional taxpayer-funded bailouts without congressional approval that would take weeks to obtain. Democratic leaders were demanding that any Wall Street assistance include strict regulations and executive compensation limits that Republicans opposed. More importantly, government officials believed that Lehman's failure, while painful, would be manageable if other major financial institutions remained stable. They had spent months preparing contingency plans that included emergency lending facilities for remaining investment banks and coordination with foreign central banks to maintain global liquidity. These preparations would prove inadequate for the crisis that Lehman's bankruptcy would trigger. At 1:45 a.m., Fuld received final confirmation that no private or government solution would emerge. Lehman Brothers would file for bankruptcy at 6 a.m. before markets opened. The 158-year-old institution that had survived the Civil War, 2 World Wars, the Great Depression, and dozens of market crashes was about to disappear in a matter of hours. The bankruptcy filing was unprecedented in scale and complexity. Lehman Brothers holdings included over 900 separate legal entities across more than 30 countries. They owed money to approximately 100,000 different creditors, ranging from major banks to individual employees. Their trading positions included millions of individual transactions that would need to be unwound or transferred. Most importantly, Lehman Brothers was counterparty to thousands of derivatives contracts with banks, insurance companies, pension funds, and hedge funds worldwide. Their bankruptcy would trigger default clauses in these contracts, forcing counterparties to immediately replace their positions at current market prices. This forced unwinding would create massive selling pressure precisely when markets were already stressed. The firm's London subsidiary, Lehman Brothers International Europe, held approximately $40 billion in client assets that became frozen when British administrators took control. European banks that had lent money to LBIE faced immediate losses because British bankruptcy law gave client claims priority over creditor claims. This created liquidity problems for European institutions that had believed their Lehman exposures were fully secured. Asian markets opened first on Monday morning, providing the initial measure of global reaction. The Nikkei index fell 5% in the first hour of trading as Japanese banks revealed substantial Lehman Brothers exposures. Korean and Australian markets declined even more sharply as investors fled financial sector stocks. European markets opened to chaos. London's FTSE index fell 4% immediately, while Frankfurt's DAX declined 5%. Banking stocks were hit particularly hard as investors tried to assess which institutions might have significant Lehman exposures. Royal Bank of Scotland fell 20%, Barclays declined 15%, and Deutsche Bank dropped 18%. American markets opened at 9:30 a.m. to the worst trading conditions since the 1987 crash. The Dow Jones Industrial Average fell over 500 points in the first 30 minutes as investors sold everything with any connection to financial services. Lehman's stock, which had traded above $80 just 18 months earlier, was essentially worthless. But the real damage was in credit markets, where banks stopped lending to each other due to uncertainty about counterparty risks. The LIBOR rate, the interest rate that banks charge each other for short-term loans, spiked to levels not seen since the 1987 crash. Money market funds, traditionally considered the safest investments outside government securities, began breaking the buck as their Lehman Brothers holdings became worthless. Corporate bond markets froze as investors refused to purchase new debt from any financial institution. Companies that needed to refinance maturing debt found no willing lenders at any reasonable interest rate. The commercial paper market, which provides short-term funding for corporate operations, essentially shut down as money market funds stopped making new investments. Goldman Sachs and Morgan Stanley, the two remaining independent investment banks, saw their stock prices collapse as investors questioned whether any highly leveraged financial institution could survive the new market environment. Their credit default swap spreads, market measures of bankruptcy risk, reached levels that implied greater than 50% probability of default within 12 months. International central banks attempted coordinated intervention to maintain global liquidity. The Federal Reserve, European Central Bank, Bank of England, and Bank of Japan announced unlimited currency swap agreements that would enable each central bank to provide liquidity in any major currency. These measures helped prevent complete system breakdown, but couldn't restore confidence in financial institutions. The derivatives markets experienced particular chaos because Lehman Brothers had been a major dealer in credit default swaps, interest rate swaps, and equity derivatives. Their bankruptcy meant that thousands of contracts needed to be terminated immediately, creating forced buying and selling that amplified market volatility. Credit default swaps on major financial institutions reached unprecedented levels. The cost of insuring $10 million in Goldman Sachs debt against default reached $500,000 annually, implying that markets believed Goldman faced substantial bankruptcy risks despite their stronger capital position. Similar patterns emerged for Morgan Stanley, Merrill Lynch, and major European banks. The human cost was immediate and devastating. Lehman Brothers employed 26,200 people worldwide, most of whom lost their jobs within days. Their pension plans held substantial Lehman Brothers stock that became worthless, eliminating retirement savings for thousands of employees who had worked at the firm for decades. Beyond direct employees, Lehman's bankruptcy created ripple effects throughout the financial services industry. Hedge funds that used Lehman as prime broker found their assets frozen and their trading operations suspended. Small banks that had invested in Lehman Brothers' debt faced capital losses that threatened their own survival. The psychological impact was equally important. Lehman Brothers had been considered one of the most sophisticated and well-managed investment banks on Wall Street. If Lehman could collapse overnight, no financial institution appeared safe. This loss of confidence created self-fulfilling prophecies as investors and lenders fled from any institution with perceived vulnerabilities. International investors who had relied on American investment banks for access to U.S. capital markets found themselves without trusted counterparties. Emerging market countries that had used Wall Street firms for bond issuances discovered that new financing would be extremely difficult to obtain. Corporate treasurers worldwide began hoarding cash as credit markets seized up. Richard Fould's tenure as CEO ended in humiliation and anger. Congressional hearings would later reveal the full extent of Lehman's risk-taking and questionable accounting practices. Former employees filed lawsuits alleging that senior executives had misled them about the firm's financial condition while selling their own stock holdings. But the broader implications extended far beyond one man's career or one firm's collapse. Lehman Brothers' bankruptcy marked the end of an era when investment banks could operate with extreme leverage while depending on short-term funding markets that could disappear overnight. The entire investment banking business model that had evolved since the 1970s was revealed as fundamentally unstable during periods of market stress. Look, September 15, 2008 wasn't just the death of Lehman Brothers. It was the day that 158 years of accumulated reputation and relationships were destroyed by 18 months of reckless gambling. 3 Jewish immigrants who had built a global financial empire through careful risk management and gradual adaptation would have been horrified by the hubris and carelessness that destroyed their legacy. The firm that had pioneered investment banking, survived the Civil War, and financed American economic development for over a century was erased from existence because modern management had forgotten the fundamental principles that created their success: sustainable leverage, diversified operations, and careful attention to survival over short-term profits. The collapse was complete, sudden, and irreversible. By 6 a.m. on September 15, 2008, Lehman Brothers existed only in bankruptcy proceedings and financial history books. Chapter 11. Total collapse. The Lehman Brothers bankruptcy was supposed to be a controlled demolition. Instead, it triggered a global financial earthquake that nearly destroyed the world economy. Within hours of Lehman's Monday morning bankruptcy filing, the crisis had spread far beyond Wall Street. Reserve Primary Fund, a $62 billion money market fund, announced that it had broken the buck due to $785 million in Lehman Brothers debt holdings. This was only the second time since 1994 that a major money market fund had lost principal, and it triggered immediate panic among investors who had considered these funds essentially risk-free. Money market fund redemptions accelerated rapidly as investors rushed to withdraw $300 billion within 48 hours. Fund managers were forced to sell whatever assets they could liquidate quickly, flooding already stressed markets with additional selling pressure. The commercial paper market, which provides short-term funding for corporate operations, essentially shut down as money market funds stopped making new investments. But the real shock came from discovering how interconnected Lehman Brothers had become with the global financial system. Their bankruptcy triggered default clauses in thousands of derivatives contracts, forcing counterparties to immediately post additional collateral or unwind positions. Banks worldwide revealed Lehman exposures that far exceeded what regulators had expected, creating doubts about their own solvency. European banks were particularly vulnerable because they had purchased large quantities of Lehman Brothers debt, while using the firm as a prime broker for their trading operations. When Lehman's London subsidiary entered administration, approximately $40 billion in client assets became frozen, creating immediate liquidity problems for institutions that couldn't access their cash and securities. Asian markets suffered severe declines as regional banks disclosed Lehman exposures. Nomura Holdings in Japan faced potential losses exceeding $1 billion, while several Korean banks required emergency government support. The contagion was spreading across continents as investors questioned which institutions might be the next to fail. Credit markets experienced complete paralysis. Banks stopped lending to each other, except for overnight transactions secured by government bonds. The LIBOR-OIS spread, a key measure of financial stress, reached levels that indicated banks believed their counterparties faced substantial default risks. Corporate bond markets froze as investors refused to purchase new debt from any financial institution. General Electric, one of America's largest and most creditworthy corporations, found itself unable to refinance maturing commercial paper at any reasonable interest rate. If GE couldn't access credit markets, virtually no company could obtain financing for normal business operations. The economy was facing the prospect of a complete breakdown in the credit allocation system that enables modern commerce. The Federal Reserve was forced to implement emergency measures that would have been unthinkable just days earlier. They announced unlimited lending facilities for investment banks, expanded the range of collateral they would accept for emergency loans, and began purchasing commercial paper directly to prevent total market collapse. These interventions were unprecedented in scope and represented a fundamental expansion of federal government involvement in private financial markets. The Fed was essentially replacing private credit markets with government-backed lending facilities because private institutions had lost confidence in each other's survival prospects. International central banks coordinated massive liquidity injections to prevent global financial system breakdown. The European Central Bank, Bank of England, Bank of Japan, and other major central banks announced unlimited currency swap agreements with the Federal Reserve. This enabled each central bank to provide liquidity in dollars, euros, yen, or pounds to prevent foreign exchange market disruptions. But monetary policy interventions couldn't address the fundamental problem. Major financial institutions had become so highly leveraged and interconnected that any significant failure could trigger systemic collapse. Lehman Brothers wasn't just one bank among many. Their bankruptcy revealed that the entire investment banking system had become a house of cards that could fall with frightening speed. Treasury Secretary Henry Paulson, who had initially opposed government bailouts on moral hazard grounds, was forced to reverse course within days. He announced that the federal government would guarantee all money market fund investments to prevent continued withdrawals that were destroying short-term credit markets. This guarantee covered over $3 trillion in assets and represented unlimited taxpayer exposure to money market fund losses. More dramatically, American International Group, AIG, the world's largest insurance company, required an $85 billion government bailout to prevent bankruptcy. AIG had written credit default swaps on hundreds of billions in mortgage securities, and Lehman's bankruptcy had triggered margin calls that exceeded the company's liquid assets. Their failure would have forced losses on every major bank worldwide that had purchased credit protection from AIG. The AIG bailout was particularly galling because the company had claimed for years that their credit default swap business was essentially risk-free money. They collected billions in premiums for insuring against mortgage security defaults while arguing that such defaults were statistically impossible. When the impossible became reality, taxpayers were forced to cover AIG's gambling losses to prevent global financial collapse. Morgan Stanley and Goldman Sachs, the two remaining independent investment banks, faced existential threats as their stock prices collapsed and funding sources evaporated. Both firms were forced to convert to traditional bank holding companies within days, accepting federal regulation and capital requirements that would fundamentally alter their business models. This conversion marked the end of the independent investment banking industry, that had dominated Wall Street for decades. The high leverage ratios and proprietary trading activities that had generated enormous profits were no longer sustainable in an environment where survival depended on access to federal deposit insurance and emergency lending facilities. Congress was forced to approve the Troubled Asset Relief Program, TARP, which authorized $700 billion in government spending to purchase troubled assets from financial institutions. The program was deeply unpopular with voters who understood that they were being asked to bail out the same institutions that had created the crisis through reckless risk-taking. Public anger at Wall Street reached levels not seen since the Great Depression. Congressional hearings